Hello everyone. Welcome to yet another series of interviews of Project Dharohar, the Museum of Indian Securities Market. Today, we are in conversation with a seasoned expert in the Indian securities market who has a rare distinction of donning the hat both as a regulator and as the regulated entity in the market. We introduce you to Mr. Nehal Vohra, MD and CEO of CDSL, the biggest depository in the Indian securities market. We welcome you, sir.
Thank you so much. It is truly a pleasure and honor to be a part of this very important project which SEBI is trying to embark upon.
So we know that you have been associated in the Indian securities market in its transformative journey with both SEBI and with the MIs like BSE and CDSL. So how would you see this transformative journey of Indian securities market?
So I think the Indian securities market has been one of the oldest in the world. It's the oldest in Asia. It's been in existence since 1875. But it was always a human, physical-based, floor-based trading, which was paper-based settlement processes. And SEBI got created in 1988 as a bill, and it got its powers in 1992 by an act of parliament. Subsequent to that is really the real process of reforms which started. And there was a paradigm shift which SEBI underwent of transforming markets from a physical-based to an electronic and a digital-based markets. So it started off with really the floor-based trading, moving to an electronic-based national market. And in 1993, we had the first national stock exchange being created, which was kind of started as a process within the four walls of SEBI, and it kind of expanded to kind of give this kind of a paradigm shift. Earlier, which exchanges were each state-based and physically located, kind of had a different format to this entire process, where the India as a country became a national securities market. And then the process, so it started off on the trading side, and it obviously went all the other exchanges also kind of embarked on the journey. It was the first time that technology became the driver of what was going to become a very advanced and sophisticated market. So really, humans were the core, and there was computerization which was done in the existing exchanges. So the technology was the support. It's the first time that SEBI embarked on a journey where technology became the core and humans became the support. And I think that was an important journey for ensuring that the entire Union of India became one single market. The second part was obviously moving from the trading side to the clearing and settlement side. So whilst the clearing houses at that point of time were a part of the stock exchanges, it was creation of a demutualized structure where the players no longer owned. So the first national exchange was completely demutualized. It was owned by financial institutions and banks, and brokers were participants. So there was a divorce between the ownership and the trading rights, which really started the journey of demutualization also from a fairness and a governance point of view. The second big reform which happened was the creation of the depositories, and the Depositories Act got created in 1996. So whilst the Securities Contract Regulation Act of 1956, which gave the basic structure and recognition to the stock exchanges, the SEBI Act got created in 1992 and the Depositories Act in 1996. Now the Depositories Act was a process where shares which were traded in physical forms, there used to be physical signatures, and the risks of no finality of settlement happening because of a potential risk of fake votes, stolen certificates, etc. Kind of moved on by creating a separate institution which was the trusted custodian of the entire market's securities. So while some parts of the globe moved into an immobilization of securities, India embarked on a journey of creating a dematerialization of securities, and that too in a segregated account structure versus a omnibus structure, which is today also prevalent in most parts of the Western world. So when that started creating, it moved into a journey of ensuring that the market starts accepting dematerialization also as an important part of the settlement process, because it gives a finality of settlement and probably risks of bad title due to fake forge or signature mismatch, etc., was eliminated in one go. The third part, which I think SEBI embarked upon, is segregating the spot market from the derivatives market. So Badla had been in existence for many decades in India, and that was kind of a combined product. So it segregated the spot market, and it was an account period settlement where you would trade on Monday till Friday and it would all get netted off and then settled after that. Every day became a trading unit, and it moved to a rolling settlement basis. So that was the first part of the reform, and then creation of a futures and options market or a derivative market where the risk profiling, the margining system, which underlines are part of this entire framework, was made completely different from that of the spot market. Now, once this segregation happened, the risk management framework also could be segregated. So it was not a one-size-fits-all, which earlier was the case because all this was commingled as one product. When you have segregation happening, the risk management framework, the margining system, the position limits, etc., could be independently identified and defined so that it correlates with the risk which is there with that product. So that was a very important reform. So whilst dematerialization went in, and there was also a creation of two separate markets. So investors who do not wish to be a part of a more sophisticated, of the futures and options market, could really be as a part of the cash market. And therefore the price discovery was purely with buyers and sellers who had a risk profile of wanting to transact in a spot market. It was not commingled with buyers and sellers who would like to transact in the futures market. And therefore that became the second, a very important reform of segregating these two markets. The third was on the governance side. It started off with exchanges earlier. The stockbrokers or the players were part of the governance framework. There used to be a process of elections every year. And the trading rights and the ownership rights were all commingled. SEBI created a demutualization structure and embarked on a journey where all stock exchanges were asked to move towards a demutualization. So the shares which were owned or the ownership rights got converted into shares, and the trading rights got converted into a membership-based deposit right. So they were divorced of each other to again ensure that there are no conflict of interest from a governance standpoint in creating the right transparency framework for the governance of stock exchanges. Simultaneously, as the journey went a little forward, it embarked on a journey of creating clearing corporations which were specialized in the function of clearing and settlement of the market, depositories which became a custodian, and stock exchanges which became the frontline platform for price discovery to happen. So collectively, they were called the market infrastructure institutions. Whilst each one has its own specialized function, they were correlated and they were connected with each other through various modes. So there was a collective collaboration amongst MIIs, but there used to be not one player, so there were no regulatory monopoly. There were always competition to ensure that the costs were under control. At the same time, there is a choice given to the ultimate customer in taking this forward. I think along with this was the shortening of the settlement cycle. So from T plus 15, it has, today we are on a T plus 1 and an optional T plus 0. But it was a phase-wise introduction, and given the complexity of our markets, given the kind of participation which is there, SEBI has done really a great job in ensuring that this entire process of reforms, whilst it pushed the envelope in embracing these reforms, but was instrumental in increasing the participation also of the market, thereby ensuring that people start accepting these changes as a way of life. So this is from the secondary market, and primary market also went through a great change of reforms, right from a prospectus-based fixed pricing to a market determined. So the secondary market framework was embraced or put across to the primary market. So allowing price discovery to take place through the market phenomenon of supply and demand brought in a more scientific basis on which prices could be discovered. And that's how the journey has taken place, that on the foundation of all this, then you had the mutual funds which started its journey as institutions, so pooling of retail investments, but they become an institution to both the primary and secondary market. And that has also seen a great growth because it ensures that the risk profiling is done, there's broad basing of the underlyings, there are specialized functions. So I think all in all, this was kind of the journey which has ensured that SEBI, right from transactions to settlement, at core of its reforms, ensuring governance as the second part of its reforms, but transparency and market participation as a core, as a cornerstone and a foundation on which markets are built, to finally build trust in markets that more and more people can participate in it.
Great. So we know that your experience ranges from introduction of equity derivatives in India and with the depositories. So would you want to talk about the challenges that were faced by SEBI when the risk management tools in the derivatives market were introduced at that point in time?
Yeah. So India was used to Badla system, which was in existence for many, many years. And it was a spot market, derivatives market, the lending borrowing market, and all rolled into one. Now it had to first segregate this. So the spot market, that time we had many listed stocks, some small cap, some mid cap, some large cap, like we have today. And the problem was that how do you segregate derivatives to be only on large cap? So there has to be a transparent formula-based entry criteria.
Right.
Because a large cap yesterday may not remain a large cap today. So the formula has to be agnostic towards the name of the company, but more characteristic driven. So it has to be scientific and characteristic driven for it to ensure that it is resilient enough to see as the phases of the market changes. So that was the first part. Second was, whilst there was a flat margin which was charged, it had to move to a more dynamic margining system. So the entire concept of portfolio-based margining system was introduced because each customer could have a different portfolio, and therefore the portfolio risk is different from customer A to customer B. Now, if you impose a flat margin on each instrument, either for one customer it may be over margining and for another customer it may be under margining. So the system had to be intelligent enough to recognize the portfolio risk of each customer, but yet be formula driven, yet be standardized, yet be kind of neutral towards the players which are playing, but more inherent to the risk which is associated with that portfolio. So the concept of portfolio-based margining system started coming in with the futures and options market, and it led to a pre-collection of margins before the order went through. So again, there was a transformational change that before you start to put in your order, you need to have a margin in place. And it is akin to a prepaid card today, which have in phones, that you first fill in the balance, and then as you talk, the balance gets minused from that deposit which you've put in. And once the deposit is over, it automatically cuts it off. So that same concept was brought into the margining system. Now, each one of this had to be independent on the portfolio risk which is there. So there is something called a price scan range and a volatility scan range, which was introduced in the margining system. So you will have the movement of prices. So how do you determine which is within a fair part? So a value at risk modeling was done, whether 99% of the times or 99.5% of the times, financial markets are known to be leptokurtic, so fat tails. Becoming a little technical here, but the probability of that falling in the tails is high in financial markets. So you need to have a margining system which covers significant amount of that risk. And there could be a potential risk for which you need to have a second line of defense and a third line of defense, which was mooted as a part of the risk management system. Now, this looks very complex. So it had to be simplified for the customer to understand. And one of my famous favorite quotes is of Steve Jobs: "The difficult part is to make it simple." So how do you make it simple for the customer to understand, but yet have the nuances which are required to it be accepted in terms of the risk which is associated with this? Secondly, the concept of position limits also came in at that time with futures and options. So there was a certain size, so there's a concentration risk which had to be addressed. And there was market-wide position limits, there was trading member-wide position limits, and there were client-level position limits. So there were three types of position limits which were created. The stocks which had to be selected also, as I said earlier, had to go through a fair amount of screening, and various lens had to be put in to come to the right mix so that the stocks which are chosen are really worthwhile for futures and options, because it was a new market and markets needed to understand. Concept of index derivatives also came in at that time, because a lot of the institutions probably preferred that rather than single stock futures and options. So that was the entire journey on what one had to ensure, that it had to be alive and kicking, and it had to address the right amount of portfolio risk, neither over margining it nor under margining, because either side would have killed the market. So the market to thrive in a safe manner, it had to have the right amount of risk management tools.
So like you mentioned earlier, dematerialization, and rightly so, it is one of the key milestones in the development of Indian securities market. So when these key reforms were being introduced, what were the challenges that the market participants faced?
Yeah, so India had a lot of retail participation directly into the securities market. A lot of people had shares, and a lot of people wanted those shares to remain in physical form. They wanted to touch and feel. Now suddenly you have to tell a century-old system to move into an electronic-based dematerialized system of depositories, whether I should trust depositories with my hard-earned savings. Also, it's not part of the government, it's private sector, but it's tightly regulated. So therefore, the concept of a Depositories Act got created, where an act of parliament gave the power to these institutions to become the trusted custodians for the securities, because that's how the beginning of trust would begin. Second, world over, clearing corporations and depositories are kind of one single entity. In India, we decided to segregate them. And I think that was a right move, because each institution has a specialist focus on its own expertise. So depositories are in the job of being a trusted custodian for securities. Clearing corporations are doing the clearing and settlement functions. And therefore, whilst they are complementary to each other, but they are not similar, means they are distinctly different from each other. So creating these two different institutions, it created again a systemic hedge that there is not one institution which is too big to fail, and it kind of creates that segregation to take place. The second thing was how do you encourage retail investors or the person walking on the road to come forward and dematerialize? And it's a chicken and egg situation, that till you don't have critical mass, how do I mandate it? And until I don't mandate it, how do I get that critical mass? Right. So how do I start first? So I think SEBI went through a very interesting but a very scientific way of going about it. That it started first on a voluntary basis of dematerialization. And as things started progressing, as more and more companies, and it mandated the issuers, the issuing companies, to start opening their accounts with the depositories. And they had to choose both the depositories. There was a gap between NSDL and CDSL. But once that both these institutions came up, it was mandated that you needed to open a demat account, because there could be customers who may opt for dematerialization. Then it started saying that all the liquid stocks slowly moved to compulsory dematerialized settlement in a gradual way. And SEBI was at the forefront in ensuring that this was kind of mandated in the market. IPOs which came out slowly could only be in a dematerialized form. So slowly the window of opportunity, while the Depositories Act recognized and gave power to a shareholder to hold the shares in physical form, to convert a dematerialized security into a physical paper rematerialized security. But the efficiency of the market was if everything moved into a dematerialized form. So SEBI slowly gave that nudge to the market that the entry points for a paper to come in was slowly moving into a dematerialized form. Similarly, trading also in these liquid, the institutions insisted that it needs to be dematerialized. So that created the relevant impetus for more and more people moving towards a dematerialized form. And then it moved the needle to go right down to all securities. And then they had a special window, I remember, where physical shares could be traded, but then the buyer and seller both had to be physical, and the price used to be at a relevant discount to the normal trading price. So then the seller would not want to sell that. So that would give another. So it was a very well thought of mechanisms to let the market move towards a dematerialized structure. The second thing is that SEBI took the hard decision that it would be a segregated account structure. So each customer would have his own demat account, which was not commingled with the broker's demat account. Now, why this is important? It is important that suppose if the broker goes bust or he goes bankrupt, if I have a segregated account structure, the depository can port my demat account from one broker into another broker without doing, it will be very easy to do that. So it builds trust. Second is, even if the broker doesn't go bust, if it is an omnibus structure, I can use your securities for my obligations and you would not even know about it. So here there is a check. At each customer can check what its balance is, which is certified and validated by the depository, independent of the broker. So there is a direct information flow happening between the depository and the customer. I think that was another important journey, which is critical in building this trust on why the depository system became more popular in India. The third thing which I think SEBI also did, which was very, very critical, is that PAN was mandatory for demat accounts. Now that became a very important reform because it became a unique identifier. So today, if I, from surveillance reasons or from risk management reasons, if my trading platform, my clearing and settlement function, my depository is all connected to PAN, it becomes easy for me to collect this data and process this data. Now, most of global jurisdictions are really struggling with this problem because there's no unique identifier and it's all commingled. So how do I segregate it from a safety point of view, from a risk management point of view, and from an integrity point of view? So there are three lenses why this segregated account structure linked to a PAN was a very important reform, which ensured that whilst the growth took place, there was a lot of checks and balances which could be incorporated as the reform process went forward over the years. So this was kind of the historical perspective on what were the challenges and how they were kind of overcome.
So as you talked about, the trust has gone a long way in building the number of accounts in the securities market. We have seen a surge of 15 crore demat accounts in the depositories today. So how do you see this exponential growth? And what role do you think COVID-19, the emergence of mobile trading platforms, and the policies of CDSL have been playing in this?
So I think CDSL, and I think that way both the depositories, but where we have embarked upon is the segregated account structure which I spoke about. On that, there was a layer built of a unique concept where whilst the demat accounts are connected through a depository participant, which is an intermediary, which could be a stockbroker, the authorization happens directly with the customer. So it's a B2B business, but a B2C authorization. Now, what that has led to is that whilst the transfer has to take place and it got commingled with the order management system. So if I want to sell 1,000 shares of a company A, the broker will not allow me to do it unless I've authorized him to debit my account for 1,000 shares of that company A. Now there was a mechanism which had evolved over in the formative years, where there was the general power of attorney given, where all the shares, anything could have been debited. Now that could be subject to misuse. Okay. So there was a concept of EDIS, or Electronic Delivery Instruction System, where CDSL has been at the forefront. What that entails is that I give specific instruction for the order which I am placing. So I'll only give the depository participant the ability to debit my account with 1,000 shares of that company A. Now, the question you'll ask is that normally you have to write a physical delivery instruction slip. So we moved into something called an electronic delivery instructions. There was no physical signing of the DIS. It was like signing of a check. So there would be moment a broker would want to place, suppose your order of 1,000 shares of company A. At the time of order entry, there would be an application protocol interface or API, which would get activated with CDSL. That order is connected to your DMAT account. So it will pull out the details. The system itself will pull out details and say there are 1,000 shares. Now, before it gets blocked, you need to authorize that block to happen. So they would send a one-time password. The depository will send a one-time password to you directly. And it will open a screen, an authorization screen, on top of the broker's screen. Now you enter that one-time password into that screen. Broker has no visibility on this. It's only between the depository and the customer. Moment you enter the right OTP, you have authorized it to block it. So the shares remain blocked in your account, so you cannot resell it or repledge it. But at the same time, the depository then gives a go-ahead to the broker electronically that these many shares have been blocked in your account, you can go ahead with the order. So all this happens in a fraction of a second because orders are time sensitive. You go ahead with the order may not culminate into a trade of 1,000 shares. It may be a trade of only 700 shares. Now the interesting thing is here that the depository will not transfer 1,000 shares to the broker because the obligation is only 700. So at the end of the day, the depository does a reconciliation with the clearing corporation on what is your personal obligation. So every customer's obligation is mapped. So there it was blocked for 1,000, the obligation is 700. It will only allow 700 shares to get transferred to the broker, remaining 300 becomes free balance. So the system is intelligent enough or designed to ensure that only that many shares get transferred as per what is required to be transferred. Nothing more than that. So that was the first very big reform which happened, which is nowhere else in the world. And that ensured that the system could be trusted upon. The second one was the margin pledge system. And I think SEBI has been in the forefront of designing this system. So earlier when you had to pledge for margin purpose, you had to transfer it to your broker's account. Now the trading member, whether it's transferring to the clearing member or transferring to his own account, would not be known. So siphoning out was a possible risk. Margin pledge brought in a system that when I want to pledge to you, again say 500 shares of company B for a position which I'm taking, I will impose that margin pledge flag, a depository flag will come, so I cannot resell it or repledge it to anything. You are the trading member. Now the trading member may repledge it to the clearing member to the extent of only 300 shares. Now shares yet don't move. There is another flag which comes that you have repledged it in my account, that you have repledged it to the clearing member. So I have the entire audit trail that 500 to my trading member, 300 has been repledged to the clearing member. Clearing member has repledged 100 to the clearing corporation. That also comes on mine. Now the clearing corporation out of 100 shares invokes only 50 shares for its requirements. Now shares don't go to you or the clearing member, it goes directly to the clearing corporation or to the extent of 50. The remaining gets released back to the clearing member. The clearing member out of the 300 or now 250 will invoke only 100 shares. So again, it moves directly from my account into the clearing member's account and it releases the remaining. And the remaining 500 shares 50 has been invoked, 100 has been invoked, so 150, so 350 left, out of which you invoke only 100 shares, 100 moves to you. So system is intelligent enough to transfer shares only to the people who it needs to. Plus, the customer has an entire audit trail on where it has been pledged and repledged. And the third and the most important reform is that any corporate actions like bonus, splits, which earlier used to be a big problem because the shares are lying with the broker. So the bonus, whether he'll transfer it back to the customer. Now it is lying in my account only. So the bonus, all corporate actions will continue to remain in my account. So that brings in the trust. Now, when all these reforms, when you see, when COVID hit us, securities market was probably one of the only industries which worked without a glitch. And everybody was working from home. So the vision of SEBI in 1990s of moving in everything from a physical mode to a digital mode, the dividend was seen in COVID when everybody was forced to work from home. Because the entire ecosystem was so, not only SEBI was working from home, the MIs were working from home, the intermediaries were working from home, and the investors were also working from home. You had no other means of livelihood or activity. So it was again a very important social impact also that a lot of people started seeing as a source of activity and a source of livelihood also. So a lot of people, and the point of first call was opening a Demat account. Because for any trading to be done as a part of a KYC, Demat is required. And because of these efficiencies, that right from account opening to the transactions to the pledging, all that is online. And I can do it from the comfort of my home with full security, brought in that trust element. And therefore, this entire surge. I remember in 2019, when I took over this job in September 2019, CDSL had about 1.8 crore Demat accounts, not too far behind. Total size was about 4 crore of the depository industry. Today, CDSL itself is at 15.5 crore Demat accounts and the total depository size of about 19.5 crore. Now, this shows the exponential rise, the dividend of digitization and the dividend of having a very fair, transparent and truthful system which allows this growth to take place is what, in my opinion, has caused this entire growth to take place.
Right. I think the technological preparedness that you talked in the beginning and the trust through policy that was being reinforced,
that's right.
That made it still.
That's right. That's right.
So on the way forward as MD and CEO of CDSL, how do you see the depositories driving the financial inclusion and growth in our system?
So I think there are various methods which the depository is at the forefront. As I said earlier, it's a B2B business, but a B2C connect and an authorization. The depositories have something called a consolidated account statement, which is culminates all the assets and sends it directly to the customer. So it's an ease of ensuring that all my assets are coming to me as in one statement. CDSL has embarked on the journey of ensuring that it's not only in English, but in 23 languages. So that shows that you don't need to know English to transact. So it is from a financial inclusion standpoint. We've seen a lot of Demat accounts being opened in Tier 2, Tier 3, Tier 4. In fact, 75% plus is in Tier 2, Tier 3, Tier 4 cities. That shows that there is an aspirational side to this entire journey. That I'm participating in national markets with the efficiency of getting my money on a T+1 or a T+2 basis by the time the money and the securities come in. But I am getting the efficiency of price discovery happening at a national level. And that brings in a lot of safety. When I need money, I can get it on the go with a very fair price discovery. Second is, I think, this investor app which the depositories have put across, where I can see all my holdings, all my orders, all in one place. And it's coming from mobile phones, so it is easy for me to see it. So I think there has been a graduation, especially a lot of Gen Z and Gen Alpha coming into the markets.
Right.
They like control by themselves, and this is giving that control to themselves. So I think the entire genesis is moving towards how do I become self-sufficient? How do I become Atmanirbhar?
Right.
Where I gain knowledge, but I should have the ability of looking at my assets myself.
Yes.
And that is one important investor education focus. That it's not about only telling people what is good and what is bad for them, but teaching them how to read this, teaching them how
Right.
to access it, so that they become self-sufficient and independent of anybody. As a famous management saying goes, that if you give a hungry man a fish to eat, he will feed himself for a day. If you teach him how to fish, he'll never
Right.
remain hungry. So similarly, creating that framework that investors are able to access and create the highest amount of safety and product suitability for itself, then you are going to create long-term participation, long-term wealth. And I keep on saying this, that there is so much material available. You need to invest that time within yourself, because it's your hard-earned savings which is going into these markets. So that's from the investor standpoint, the inclusion is happening. It's like a wallet, a digital wallet, where I have all my securities market assets out there. It also has an ability to pledge it, as I talked about margin pledge. The financialization of my assets also happens through that. My KYC is powerful because I have multiple assets in the securities market, but I have one single KYC. So if I change my house, it automatically changes in all of
Right.
that. Fourth is, there's a process of e-voting. So the investor app is a single sign-on. So if I have 50 securities and there are 100 resolutions, I don't need to go to each company. It's all culminated into the investor app as a single sign-on. So that gives me an ability to become active as a shareholder also.
Yes.
Moment I become active, my interest in reading about that company is going to grow. Therefore, I'm going to invest more and more of my time into it. Also, there has been a lot of services which are given as a part of the Demat account, in terms of ensuring that my past transaction statements, what has been my holding statements, what would be my capital gains, etc., will be all part of the investor app which has got rolled out. And this is all a process of evolution and development. This is only going to grow upwards. So more and more power to each person to able to kind of be in charge of his or her assets, and training oneself towards that is an important component of this entire journey on what depositories play in terms of ensuring financial inclusion for markets.
So we began with technology, how technology laid the foundation stone for many of the key reforms in securities market. Now, as we talk about technology in today's times, we are seeing a lot of advancements in AI. We are seeing a lot of advancements in cybersecurity. And we are seeing the regulatory and supervisory technologies evolving.
Yeah.
So what's your take on that?
So I think technology has four main components to it. So you have the hardware, you have the applications, you have the network, and you have the security. So these are the four important components of technology, how it connects. Now, the way the market infrastructure institution framework has evolved in India, where exchanges play their own role, clearing corporations play their own role, and the depositories play their own role. But each has been able to expand in these four areas of technology which I have said. So, there are going to be constant challenges as well as opportunities, both from reforms as well as risks which get associated with technology. Now, AI becomes critical because as scale grows, it becomes beyond human eye to look at the efficiency aspect. So
Exactly.
it's a hybrid approach which it moves into, where routine actions get created or done by the technology systems. Certain monitoring can be done by pre-programmed artificial intelligence systems. And then you have the human eye, which supplements this on top of this to create that kind of safety and integrity of the markets. Now, as we grow, the AI has started happening a lot in the day-to-day functioning of markets.
Right.
So, less and less is human driven, it's more and more technology driven. And human becomes only the exception to look at certain aberrations in case if it happens. There also AI is now coming in terms of subtech and regtech, where it gives you that what has been the past trends, what has been the aberration. So it helps the human to kind of zero down to the possible cause of why things are happening. So it gives a lot of history into the decision making for the human to take place. The second thing is also a lot of the capacity planning, the network planning is AI driven, because sudden surge in accounts, or how do you ensure you're planning well in advance for that capacity in case if certain capacity has to be drawn for a specific instance, etc. Those is where AI has a role to play. On the regulatory side, the RegTech is something which is picking up.
Yes.
There has been a paradigm shift where it's not only the responsibility of the regulator and the MIIs to ensure integrity of the markets, but it's also the intermediaries' responsibility to ensure. So a lot of data is getting flown from the MIIs to the intermediaries to help them surveil markets better. So we are increasing the touch points so that more and more people are looking at data from different lens. So if there are any issues, it can come back, and then the corrective action, etc., can be taken. Obviously, with each power comes certain risks, and cybersecurity is going to become a critical risk because data is now all in digital format. So creating the right amount of security, not only as a security service, but also DevSecOps is a new concept which is coming in. So whilst programming my application, I bring in security components as a part of my programming framework. So it is at its inception, I'm including security as an important component of my entire posturing of my infrastructure. Resilience and recovery is also an important component of cybersecurity.
Right.
So whilst you do all the preventive measures, you need to also have an action plan that, God forbid, if something goes wrong, what I'm going to do next, how I'm going to recover, how fast I'm going to recover, and how well I'm going to recover. The communication plan also needs to be put in place to ensure that the entire journey is ensuring that these risks are constantly being monitored. So you need AI and generative AI also to some extent to help the human to monitor these risks. But the risk is something which could grow exponentially because the level of sophistication is growing, and therefore that understanding of how do I keep security at pace and security risks which it poses is mitigated at the same intensity and fervor.
Right.
Because some people could look at security as a cost center and not as a business enabler.
Right.
But I think there's a need to start thinking, a change of thinking, that a secure organization will also prove as a great business enabler.
Right.
And therefore, there's a thinking change which has started happening in some quarters, where the strategy includes the security posturing, the security framework also, because a secure organization would be a trusted brand. So trust and security go hand in hand.
Yes.
The integrity aspects, what you talked about, RegTech and SupTech, are also important. So RegTech is important both to ensure that you're in compliance with all the smallest nuances and you have technology to take care of it and exceptions getting thrown out. But the process of escalation right up to the top management, wherever required, or even the board, is an important component which needs to be kept in place as a part of your framework. Because if the man in the middle could jeopardize it, the system should kind of pull that up and escalate it to the next level. And that ensures that the human risk is also mitigated to a large extent as a part of the system flow.
Right. Thank you, sir. It was a very interesting and informative session. And we had a lot of interesting takes on the history in Indian securities market, as well as some thought-provoking insights on the future. Thank you, sir.
Thank you so much. And it was truly a pleasure being with you. Thank you.
Thank you, sir.